Simple and compound interest rate. What is it and what is it eaten with? Okay, not eaten. In the world of finance, there are two main types of interest returns, which in turn are very different and cannot be accepted as one or ignored, as various obscure financial organizations sometimes try to confuse their clients in order to get as much out of them as possible. Well, I'll explain it now. The easiest way to calculate the profitability is to count in percentage, which is called yield. To explain, let's say I invest $500 and expect some returns from them, which will be higher than inflation of course, but better than the refinancing rate and blah blah blah. This is not today's video topic. We want $50 in a year from them, which will be 50 divided by 500 multiplied by 100 and equal to 10%, where 50 is the amount of desired returns, the determination is 500, is the amount invested, and we multiply by another 100 to get the number as a percentage. But what if you invest not for 1 year, but for 3 or 5 or 10 years? And here can be offered both simple and compound interest. Let's figure it out. Simple interest rate. Let's start with the simplest and most basic. This is a simple interest rate. Here you have a formula that is quite simple, that even a third grade student can apply. Present value, meaning present value of cash flow. Let's keep it simple. The money that you have at the beginning that you are ready to invest are small. It can also be in the form of the letter K, I, big R, doesn't matter. The main topic is the interest rate that is promised to pay you at the end of the reporting period, usually measured in years, whether it's a bank deposit or corporate government bonds, or at least IRR after all. And here it is also small. Literally, you can write down the big one also. People will definitely understand you. For 100% I'm sure. However, here we do learn science, not indulge. Let's leave it as it is. The meaning is it's the time that we are going to keep the invest funds. But also, here it is the total number of periods. For instance, let us say we'll have 7% are paid per annum. Then the periods must be counted in years. 3 years will be 3, 6 months will be half a year or 0.5, 1 century is 100, and so on. Everything is clear on this. Just remember that the interest rate and number of periods must be the same scale. I mean, days, months, quarters, years. And the last thing here is the future value, or the amount that will be obtained after the money holding time. I invest the same $500 in a bank deposit for 2 years at 7% without capitalization per annum. So it turned out to be $535 for 1 year and $570 for 2 years. In 10 years it will be $850. In 20 years it will be $1,200, which may seem pretty good. This can be found in bonds where there is a coupon rate. It's calculated by simple interest and pays a fixed amount annually. For $100 at 2.7%, this is $2.7 annually. Compound interest. It's also called an investment with capitalization. When money is invested, let's say for 10 years, at the same 7%, it turns out not 70% but 96.7% to be gained. For the same time, with the same percentage. Only instead of withdrawing all the annual dividends, they continue to stay with the investment money and begin to work with them. A is future value and P is present value. I left it like that for clarity. R is understandable and 2. Substituting the same numbers, there are $500, 2 years, 7% interest rate, but it's capitalized. For a year, it's $535. For 2 years, it's already $572. For 10 years, it's $983. For 20 years, $1,934, which is already much more than a simple interest rate. If you substitute the ruler on the chart on the right, you get a straight line, while compound interest rate shows exponential growth. Yeah, the thing on the right side is the exponential growth chart. In order to let your total income or your investments to continue growing and grow, multiplying themselves, you will have to invest an amount of money. Add free-to-use funds to them, receive dividends or asset growth, but do not accept interest income as a portion of the total income. As for spendings, On the contrary, continue to invest further in your investment portfolio or just wait. And when new income comes, invest it again. And thus you will be able to exceed the simple interest on charts and reach the compound interest rate, which will be your path to financial well-being. Where is this compound interest rate can be found? In general, almost everywhere it will be available automatically, or you need to capitalize manually. If it's a bank deposit, both ways in most cases are available. If there are bonds with a periodic payment, then you can buy more bonds from the accrued funds. If the stock market, then they usually calculate the return for the year on the average, but not just in the first year the growth was 10%, in the next it was 4%, it turns out to be 10 plus 4 is equal to 14, but we add first 10% to the dollar and 4 more to them, and thus we have 14.4% at the end of a second year. So this extra 0.4% are derived from the capitalization of the previous first year. But also this 0.4 there in the form of compound interest. For example, the well-known S&P 500 brings about 7% annually in the last years. Capitalization. But what if we want to multiply our income more than once a year, more often? In fact, nothing prevents in the world of finance. The payment periods can be just once a year, or quarterly, or a month, a week. In some cases, they are ready to pay you even daily. Not to accrue, but to pay. Also, often the last in many cases can be a dubious project. In bonds or stocks, payments occur once a year or quarterly, while in the banks can be a lot of different payments. However, the most important thing is to be able to receive payments of accrued income or interest income as often as possible. An example. Times are not so good. We currently have all 20% interest rate, while payments once a year remain at the level of a simple interest rate of 20%. Then, with capitalization once a quarter, the same 20 will have a total income of 21.55%, almost 22% if per month, and all 22.13% if it's daily, which is an increase of additional 1.55%, 1.94% and 2.13% in total. Thus, this is called the effective interest rate. Sounds cool. An extra 10% increase to interest accrued. But if you do everything manually, then the benefit from once a month and daily is only about 0.90%. And it doesn't sound like a great loss to execute capitalization 30 times more often in a year. And what if you continue to constantly add money to the current invested account, say $100 monthly? Here we get such a big formula. There are even two of them. Here all the letters are already familiar, and you just need to correctly substitute all the parameters. Now, it's quite difficult to calculate this without Excel or without any online calculator. The difference between due and ordinary is when your interest is accrued at the beginning of the period or at the end. I'll explain as briefly as possible. Investing in a deposit will be the due formula, while payments on bonds, shares, debt obligations, this is ordinary. Most people will never need an ordinary at all. If bonds and lending aren't the mainly perfect investments way of people, stock dividends this day pay either very little or no payments at all. Hi Amazon. Small bonus. To be honest, the interest rate of profitability in the market can always change at any moment, for example due to both up and down, as a result of which a bank deposit opened during a recession for a long time at a good interest rate with possibility of adding money at any time can continue to earn more than other fixed income instruments during their progress period. If this video was useful for you, you can click on the like button and subscribe. There will be a lot more useful here.